You know, we tend to think that getting married comes with some nice financial perks, right? Especially when it comes to taxes. But what if I told you that for a lot of people, the tax code has this hidden trap, a financial penalty that can make filing your taxes as a married couple way more expensive than if you'd both just stayed single? Yeah, I know, that sounds like a crazy question. But for a growing number of couples, it's a reality. We're not talking about the cost of the wedding here. We're talking about a slow, steady financial drain that's literally baked right into the US tax system. So, let's get one thing straight. This is not some literal marriage fee you have to pay. It's way more subtle than that. It's a structural problem where the math inside the tax code itself it works against certain married couples. It's a penalty that just kind of emerges from how all the different parts of the code interact with each other. So here's how we're gonna break this all down. First, we're gonna pinpoint the exact places where these penalties pop up. We'll call them the fault lines. Then, and this is the important part, we'll get into the strategic moves you can actually make to get around this whole mess. Okay, the first and honestly the biggest fault line is in the tax brackets themselves. You'd think, logically, that the income levels for married couples would just be double what they are for single people, right? Well, that's not always how it works. And this is where it gets really interesting. Look at this gap. Two single people can earn combined well over $1 million before they hit that top tax bracket. But a married couple, they get pushed into that same top rate at a much, much lower income. It means they start paying the highest tax rate on way less money just because they're married. All right, moving on from income, let's talk about the next major fault line, deductions. Once again, that simple logic of just doubling the benefits for a married couple completely falls apart, and it leads to some pretty surprising penalties. This is a perfect example of how powerful your filing status is. An unmarried couple with a kid can play this strategically. One files as head of household, the other as single, and they get a way bigger total deduction than a married couple in the exact same boat. I mean, look at that difference. That's a lot of money to leave on the table just because of your marital status. The penalty gets even clearer with the SALT deduction. That's for state and local taxes. The cap is $10,000 per return, not per person. So two single filers get to deduct a combined 20 grand. But a married couple filing one joint return? Nope, they just get one $10,000 deduction. Their benefit is literally cut in half. And guess what? We see the exact same pattern with capital losses. An individual can write off up to $3,000 in losses against their regular income every year. So, two singles can write off 6 grand. But when they get married and file together, that limit doesn't double. It stays stuck at $3,000 per return. Again, you're having your potential tax break. Now you might be thinking this only hits your regular paycheck and standard deductions, but the marriage penalty also sneaks its way into your investments, and it can create a serious drag, especially if you and your spouse are both high earners. Okay, take a look at the net investment income tax. It's an extra 3.8% tax. For a single person, it doesn't even kick in until their income hits $200,000. So two singles have a combined threshold of 400 grand. But for a married couple, the threshold is only $250,000. That means a married couple starts paying this extra tax on $150,000 less income than their unmarried friends. The picture seems a little bleak, right? You've got penalties on your income, on your deductions, on your investments. But look, understanding the problem is always the first step to solving it. So the real question now is, what do you do about it? How do you respond strategically? All right, let's get into the good stuff, the strategies. Once you know where the traps are, you can start to plan around them. Instead of just accepting the tax code's default settings, you can make active choices to reduce, or in some cases, even completely reverse the penalty. So this really comes down to looking at a few key areas. Things like being really smart about your filing status, understanding the risks that come with filing jointly, and for some people, using some pretty advanced strategies that can actually turn a marriage into a huge tax advantage. Now you might be thinking, easy! I'll just file married filing separately. But hold on, it's not that simple. The IRS often penalizes that status pretty hard, limiting your ability to take certain credits and deductions. It really requires you to sit down and do the math to see if it's worth it.
And there's another risk to think about that isn't just about the numbers. When you sign a joint tax return, you are both legally on the hook for everything on it. Tax experts warn that this means if your partner commits tax fraud or hides income, the IRS can come after you too. It's a really serious thing to consider.
But it's not all about playing defense. This is where we get to go on offense. Marriage can actually unlock one of the most powerful tax strategies out there, especially for high-income earners. This is how you can flip the script and create some massive tax savings. The strategy is all about getting one spouse to qualify as a real estate professional in the eyes of the IRS. But look, the rules here are super strict. That person has to spend over 750 hours and more than half their total working time on real estate stuff. And you absolutely have to keep perfect records to prove it. But here's the massive payoff. Once one spouse qualifies, the couple can take all the losses from their rental properties, especially those big paper losses you get from depreciation, and use them to wipe out the other spouse's high-paying W-2 or business income. This is an absolute game changer. It can take a huge tax bill and shrink it down to almost nothing. Okay, so we've looked at the problems and a really powerful solution. What's the final blueprint here? What are the key takeaways you need to build into your own financial plan? First, the marriage penalty is not a myth. It's real, it's coded right into the system, and it especially hits couples where both partners are making good money. But just knowing about it is your best weapon. And if you're willing to use advanced strategies, you can actually turn marriage into a huge tax advantage. At the end of the day, you have to remember this. The tax code is just a set of rules with default outcomes. But you don't have to just passively accept those defaults. You can learn the rules of the game and you can play it to your advantage. And that really just leaves one final question for you to think about. Are you going to be a victim of the tax code, just accepting whatever financial outcome it spits out? Or are you going to become an architect of your own financial future, using this knowledge to build something better? The choice is yours.